What if rebuilding your credit score wasn't about making massive sacrifices, but about starting a few small, almost effortless habits? Today, so many people see bad credit as a mountain they have to climb, full of complicated rules and stress. But what if I told you that by the end of this video, you'll have a handful of simple, straightforward steps that can start repairing your financial life right away? We're talking about unlocking better opportunities like lower interest rates and getting the keys to that apartment you've been eyeing. Stick with me, because we're about to make this whole process make sense. If you've ever felt that sting of a loan denial, the frustration of a crazy high interest rate, or just the confusion of not knowing where to even begin with your credit, you're in exactly the right place. For years, I was convinced a bad credit score was a permanent stain on my record. I'd made some mistakes, missed a few payments, and watched my score tank, thinking it would take a miracle to fix it. But after a ton of research and a little discipline, I discovered something that changed everything. Rebuilding your credit isn't some secret formula. It's about knowing the rules of the game and then building a few simple, powerful habits. In this video, I'm going to break down the exact, actionable steps I took and that you can take to build your credit back from the ground up. We're not talking about those risky credit hacks that can blow up in your face. We're talking about sustainable, almost effortless strategies that put you back in the driver's seat. We're going to turn that mountain into a few small hills you can conquer one by one. By the end of this, you'll have a clear roadmap. The why. The life-changing power of a good credit score. Before we get into the how, let's talk for a minute about the why. Why should you care so much about some three-digit number? Well, that number is one of the most powerful figures in your financial life. A good credit score, usually seen as 670 or higher, isn't just for bragging rights. It's a key that unlocks a much better and cheaper financial world. First off, it saves you a shocking amount of money. Let me paint you a picture. Imagine you're buying a $30,000 car. With an excellent credit score, you might snag an auto loan with a 5% interest rate. Your monthly payment would be around $566, and you'd pay about $3,960 in total interest. Now let's say your credit is poor. That interest rate could easily jump to 15%. Suddenly your payment is $713 a month, and you're paying a whopping $12,780 in interest. That's almost $9,000 extra just because of your score. The same logic applies to mortgages, where the difference can be tens or even hundreds of thousands of dollars. But it goes way beyond loans. Landlords almost always run credit checks, and a good score can be the difference between getting approved for your dream apartment or getting passed over. It might even mean a lower security deposit. Utility companies and cell phone providers might waive security deposits if you have good credit. In many states, even your car insurance bill can be lower. And finally, a good score gets you access to the best credit cards, the ones with amazing cashback rewards, travel points, and perks like airport lounge access. So when we talk about rebuilding credit, we're not just talking about a number. We're talking about real money in your pocket, better opportunities, and way less financial stress. It's about having the freedom and the options to build the life you actually want. The how. 7 simple steps to rebuilding your credit. All right, let's get into it. We're going to break this down into simple, manageable steps that play directly into the 5 key things that make up your FICO score. And over 90% of top lenders use FICO. Those factors are payment history, 35%, amounts owed, 30%, length of credit history, 15%, new credit, 10%, and credit mix, 10%. Knowing these is like getting the questions to the test ahead of time. Step 1. Become a credit detective. Review your reports. Your journey starts with a little detective work. Before you can fix a problem, you have to know exactly what it is. You have 3 credit reports, one from each of the major bureaus: Experian, Equifax, and TransUnion. These reports are the report cards for your financial life, and guess what? They can have mistakes. You're legally entitled to a free copy of your report from all three bureaus every single year. The official site to get them is annualcreditreport.com. Here's a pro tip. Instead of pulling all three at once, pull one every 4 months. That way, you're basically monitoring your credit all year long for free. When you get your reports, you're looking for anything that seems off. Check your personal info. Look at the accounts listed. Do you recognize every single one? An account you don't recognize could be a sign of identity theft. Are the balances and credit limits correct? And most importantly, look for late payments that are listed incorrectly. A payment you know you made on time might be mistakenly reported as late, and that can seriously drag down your score. If you find an error, you have the right to dispute it. It's a straightforward process you can usually start right on the credit bureau's website. You just explain the mistake and upload any proof you have, like a bank statement showing a timely payment. The bureau has to investigate, usually within 30 days, and remove any proven errors. Getting just one inaccurate negative mark removed can give your score a huge immediate boost. It's the easiest place to start because it's just about making sure your story is being told correctly. Step 2. The golden rule. Pay every bill on time. If there is one habit to rule them all, this is it. Your payment history is the single biggest piece of your credit score, making up a massive 35%. More than anything else, lenders just want to see that you're reliable and pay your bills when you say you will. Just one late payment can tank your score and hang around on your report for 7 years. The solution is simple, but it takes discipline. Pay every single bill on time, every single month. And I don't just mean credit cards and loans. This includes utility and cell phone bills, as some companies might report you if you pay late. Even if you can only afford the minimum payment, paying that minimum on time is absolutely critical. It keeps your account in good standing and stops a late payment from ever being reported. The most effortless way to make sure you're never late? Automate everything. Log into your accounts for every credit card, loan, and bill, and set up automatic payments. You can set it to pay the minimum or the full balance a few days before the due date. Think of it as a safety net. Even if you forget, the system won't. Just make sure you have enough cash in your bank account to cover the payments so you don't get hit with overdraft fees. If you have accounts that are already past due, that's your first mission. Get them current as fast as you can. If you're struggling, just call the creditor. Many have hardship programs and would much rather work out a plan with you than send your account to collections. Once you're caught up, your new mantra is simple: automate, automate, automate. This one habit is the foundation of a great credit score. Step 3. The 30% rule. Master your credit utilization. The second biggest factor in your score is amounts owed, which is 30% of the pie. Now, this isn't just about how much total debt you have, it's really about your credit utilization ratio. In simple terms, that's your credit card balances compared to your credit card limits. Here's the rule of thumb. Try to keep your credit utilization below 30%. So, if you have one card with a $10,000 limit, you should aim to keep your balance under $3,000. If all your cards combined give you a $20,000 limit, you'd want your total balance across all of them to stay below $6,000. People with the absolute best scores often keep this ratio even lower, in the single digits. Why does this matter so much? A high ratio screams to lenders that you might be stretched too thin and relying on credit to get by, which feels risky to them. Keeping it low shows you have self-control. So how do you manage this without a ton of effort? First, if your balances are high, make a plan to pay them down. Always try to pay more than the minimum. The best habit of all is to pay your statement balance in full every month. Your utilization stays low and you pay zero interest. Win-win. Here's another little trick. If you have to make a big purchase on your card, try to make a payment before your statement closing date. Issuers typically report your balance to the bureaus once a month, right after the statement closes. By paying it down early, you can make sure a lower balance is what gets reported. It's a small timing tweak that can make a big difference. Step 4. The power of patience. Let your accounts age. This next factor makes up 15% of your score, and it's all about patience. Lenders love to see a long, stable history of you managing credit well. This includes the age of your oldest account, your newest account, and the average age of all your accounts combined.
The habit here is literally doing nothing, which is as effortless as it gets. Keep your old credit cards open.
So many people make the mistake of closing an old card as soon as it's paid off. This can hurt you in 2 ways. First, it can drop the average age of your accounts. If you close a card that's 10 years old, you've just erased your longest credit relationship. Second, closing a card lowers your total available credit. This can instantly spike your credit utilization ratio. For example, you have $20,000 in total credit limits and a $5,000 balance. Your utilization is 25%. If you close an old, unused card with a $5,000 limit, your total limit drops to $15,000. Your balance is still $5,000, but now your utilization just jumped to 33%, which could hurt your score. So unless a card has a crazy annual fee you can't get rid of, just keep it open. You don't have to use it all the time. Just put a small purchase on it every few months, like a coffee or your Netflix bill, and pay it off right away. This keeps the account active and lets it continue to age gracefully, rewarding you for your history. Step 5. Diversify your portfolio. Your credit mix. Your credit mix makes up 10% of your score. Basically, lenders like to see that you can handle different kinds of credit. There are 2 main types: revolving credit and installment loans. Revolving credit is things like credit cards where you can borrow and repay as you go. Installment loans are things like a car loan, a mortgage, or a personal loan. You borrow a set amount and make fixed payments until it's gone. Having a healthy mix of both shows you're experienced. Now, let me be crystal clear. This does not mean you should go get a car loan just to improve your credit mix. That's a terrible idea. This is one of the smaller factors, and you should never take on debt you don't actually need. But as your life evolves, it's something to be aware of. If you only have credit cards and you were already planning to take out a small, manageable loan for a real reason, it could have the nice side effect of boosting your mix. The best way to tackle this if you're starting out, though, leads us right to the next step. If you're finding these steps helpful and you're starting to feel like, hey, I can actually do this, then do me a favor and hit that subscribe button. We break down confusing financial stuff into simple, actionable advice every single week, and I'd love to have you in our community. All right, let's get to the final steps. Step 6. The training wheels of credit, secured cards and credit builder loans. So what if your credit is so damaged that you can't get approved for a normal credit card or loan? How are you supposed to build a positive history if nobody will give you a chance? This is where 2 amazing tools come into play: secured credit cards and credit builder loans. Think of them as training wheels for your credit. A secured credit card works just like a regular one, but it's secured by a refundable cash deposit you make up front. This deposit is usually your credit limit. So you deposit $300 and you get a card with a $300 limit. This takes all the risk away from the lender, so they are way easier to get. You use the card for small purchases and, most importantly, pay the bill on time every month. The card company reports this good behavior to the credit bureaus, building a positive history for you. After 7 to 12 months of responsible use, many companies will upgrade you to a regular, unsecured card and give you your deposit back. A credit builder loan works a little differently. Here, the lender doesn't give you any money up front. Instead, they put the loan amount, say $500, into a locked savings account for you. You then make small monthly payments. The lender reports these on-time payments to the bureaus. Once you've paid the loan in full, they release the money to you. It's basically a forced savings plan that also builds your history of paying an installment loan. Using one or both of these tools is a nearly guaranteed way to establish or re-establish a positive credit history when all the other doors seem closed.
Step 7. Be strategic. Limit new credit applications. This last piece of the puzzle is new credit, and it affects 10% of your score. Every time you formally apply for new credit, it puts a hard inquiry on your report, which can cause a small temporary dip in your score. 1 or 2 isn't a big deal, but applying for a bunch of new accounts in a short time can make you look desperate for cash, which is a major red flag for lenders. The habit here is to just be thoughtful. Don't apply for that department store card on a whim just to save 15%. Apply for new credit only when you actually need it and you're pretty confident you'll be approved. Try to space out your applications. There is one important exception. Scoring models are smart enough to know when you're rate shopping for a big loan, like a mortgage or car loan. If you have multiple inquiries for the same type of loan in a short window, usually 14 to 45 days, they're treated as a single inquiry. So you absolutely should shop around for the best rate on those. But for everything else, be selective. This simple restraint shows lenders you're stable and in control. And there you have it. Rebuilding your credit isn't some overwhelming mystery. It really just boils down to a few simple, consistent habits. Let's recap the game plan. 1. Check your reports. Put on your detective hat and clean up any errors. 2. Pay on time. Automate your payments. Make this non-negotiable. 3. Keep balances low. Live by the 30% rule. 4. Keep old accounts. Let your credit history age like a fine wine. 5. Mix it up wisely. Over time, show you can handle different types of credit. 6. Use training wheels. Use secured cards or credit builder loans if you need a fresh start. 7. Apply strategically. Be thoughtful about when you ask for new credit. Building good credit is a marathon, not a sprint. It takes patience, but as you can see, the steps themselves aren't that hard. They're small tweaks to your financial routine that over time add up to a massive transformation. You have the roadmap now. Start with step 1 and just take it one hill at a time. You've got this. If this video helped you, I think you'll get a lot out of my other video on creating a budget that actually works. It's the perfect next step to make sure you always have the money to pay those bills on time. Thanks for watching, and I'll see you in the next one.